Hey, welcome to the Compassionate Capitalist Show. I'm Karen Rands, and I'm flying solo today because I wanted to share, uh, you know, an experience I had just recently when I attended the TICON convention in Atlanta. TI initially was for the Indus entrepreneur. Now it's for the innovation entrepreneur. It's a global organization that really is amazing in the way that it cultivates entrepreneurism and funds and gets access to capital, particularly for minority and underrepresented founders. Um, in fact, I've been, I've probably heard me mention it before because I've been both a mentor and a judge for their business plan competitions. Uh, 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 Most of the companies that I've mentored have either went first or second, tied for first or something like that in the last 4 or 5 years that I've been doing the mentoring. And I flipped back over to be a judge this last time because I'm just too busy. But I love the organization, and the TICON convention was even more powerful. And, because I know so much about angel investing, since I wrote the book, right? uh, I have, I went to learn, went to sessions to learn something different. I did a fintech, which was fascinating, and supply chain management. But then the end of the day, they did a panel conversation about with venture capitalists and angel investors, and it was about best practices for minimizing your risk, and how do you approach being an angel investor. And these are folks that were many years, like decades, they've been doing this, and they had their own venture funds, and all of that. It was and so what was so rewarding for me, because you go like, oh, I want to see, is there anything new here? What have I missed? Because I'm, whatever. And what's changed, and all that kind of stuff. And uh not a lot. It's exactly what I teach in my book and in the courses that I'm putting together for investors right now. So if you haven't gotten the book, if you're new to angel investing, if you're not somebody that's part of an angel investor group, um, investing in entrepreneurs on a regular basis, have your system and processes down, like these gentlemen I'm going to talk about, get the book, because it'll give you, it is the primer, step by step. What do you got to do to get started? Should you, would you, could you invest in entrepreneurs and private companies? Uh, I don't go into a lot of detail about the different ways to invest based on the crowdfunding platforms. I'm intending to bring another book out with that information if I can get my scale book done. Yeah, but I, I but it's a primer, right? And I'm probably going to do the digital course on how to do all that stuff before I get the actual book written. So go to shameless promotion here. Go to KarenRands.co, same as Cougaran, KUGARAND.com. And yes, there's a coffee cup there. I just had my aha moment on, maybe people think I'm in the coffee business, but that was the coffee cup is there at the bottom of the page or on the contact page, because in my infinite cleverness, the tips that I send out on how to, you know, attract capital, how to invest, all that kind of stuff is 2 minutes. It was supposed to be the Compassionate Capitalist coffee break because nobody reads newsletters. And so this way people might just take 2 minutes out of their day to hear me answer a question. So that's what that's all about. The coffee cup's going. We're just trying to figure out what else to put there instead. Dollar sign. Anyway, let me get back on my topic. So this is about diversifying your angel investor portfolio to maximize your return on investment when you do that. And how does it position against other assets? And the people on the panel, it was Bird Blitch, who is a highly successful entrepreneur, was the co-founder of Patientco, and it was the next gen payment systems for the medical thing that got acquired. And um serious, like when you Google his name, the first thing that comes up is net worth. So it wasn't his first company. He's been highly successful, had some good information, and and real humble kind of a guy, real, like, not none of the bravado that you would think of a tech company that had a huge exit and now you're a successful investor in companies. None of that kind of stuff that you see sometimes. But and then there was JP James, also another wonderful person, former president of Thai. I've known him over the years. He has really led the community of it within Thai to establish the Thai Angels, to set up their processes, and has his own company. He's had other funds that he's been a part of, Hive Financial Assets, that is a really unique approach to financing and funding in entrepreneurs and putting other people's money to work in that way. He's just been a leader in our local community in a lot of ways, and an incredible mentor to entrepreneurs. He also teaches over at Georgia Tech. And you had Frank Tai. He is he, lots of background in entrepreneurism and investor. And he's currently the managing director of Silicon Road Ventures, which is an early stage VC fund focused on the future of commerce, fintech, e-tailing, supply chain, things like that. I'd met him for the first time at the TICOM. Shankar Ram, he is a serial entrepreneur, mentor, and investor. He has started 6 companies and had successful exits, including exits to UPS and Ernst & Young. He's currently on the board of Thai Global and Thai SoCal. He was one of the most fascinating people. And again, I talked to him afterwards and got to know him. And a bunch of these guys have been invited to be on the Compassionate Capitalist show, and hopefully you'll have an opportunity to hear their stories and directly, subscribe now. And then Sid Mukherjee, who is currently president of Thai Atlanta. He's the managing partner and founder of Silicon Road VC. He led the panel discussion. He's a retail innovator. He successfully built and sold a company operating in 8 countries, serving 350 retailers worldwide. And with that huge success, he started the Silicon Road VC, and they got a big conference they're doing next year on the future of retail that if it's not on their website, I'm sure you'll be hearing about it, but it's going to be really exciting to participate and see what's going on in that space. He's also passionate in mentoring and coaching Atlanta's startups of tomorrow. Okay. So here's what they had to say. So JP started out sharing that there's 4 assets, right? Equities, stock, or equities, which are stocks, fixed income, debt, bonds, money market and cash equivalents, and real estate and other tangible assets, right? And so within equities, which depending on how you mix it up, in his particular case, 30% of his portfolio, with 20% in what he calls speculative, which works out to be about 6% overall in private stock. And the bigger your portfolio goes, these numbers will change. And depending on where your level of risk is, right now when you're getting started, in the book, I talk about the average of 20% of your portfolio is in the speculative alternative kind of a thing, or allocating a certain amount towards that. If you're new starting out, you may not have as many assets to allocate, so it's going to change over time, and you need to do what you're comfortable with, very comfortable with, right? Because then Frank shared that in his case, because he has experience and believes that investing in entrepreneurs and in private equity, angel investing, venture capital investing has the highest rate of return. And he shared some statistics. I did a one of my podcasts that I did a few weeks back where I talk about why you should become an angel investor. And I compared the average rate of returns of angel investing, even though it's highly risky, still is 3 to 4 times what the average rate of return is for regular public stocks and real estate, which are the bigger, the more tangible types of assets that people use to grow their wealth. They invest in those where, bonds a lot of times are a safety provision. Same thing with money market, kind of stuff. They're not going to grow in value a lot. They're very predictable, but they're also very low risk, right? And so that's why you have to have the diversification. But he allocates a full 10% of his entire portfolio towards that. So, because it's high, he's in a build mode, but he also has, he's got wiggle room to lose, right? When you're highly successful in an exit, of a company, you have because you had what you had was a company, and then now you've got, millions and millions and millions or more of money. You can put more of it because you didn't have it before. You know what I mean? You could make more of a risk. But like when I was starting out, and a lot of my investors and who the book is kind of written towards are those people that are in corporate America. They've got day jobs, or they're running their own company, and so they their approach is going to be sort of different on that. And the big thing that I talk about with them is an amount that you feel comfortable with versus a percentage of. So if you know that you're going to get a corporate bonus every year, or in the book, I talk about taking money out of your 401k, your company backed 401k that you might have $900 million in if you've been with a corporate America job for 10, 20 years. If you're a millennial, who a lot of millennials like to want to get it started in Reg CF, it's going to be a little bit different. So you do the amount, like Jason Kokonis said, if he was a millennial, if he was 20 something starting out in investing, he would do $500 a month. Okay, so it was an amount, not so much because that's how much he could afford. He would be okay with losing, because it'd be like what he was spending on, social things, or things that he's just going to consume, right? So in this case, he just would put it towards that. He was doing it in that case, he was doing it instead of investing in his 401k at his company, because you don't get matched until you've been with the company for 5 years. So go ahead and put it into this. And I have another podcast where I talk about the likely outcomes and the return that you would get, even if you had crappy outcomes. If you just did what the VCs usually say, which is 1%, 1 out of 10, and 2 or 3 out of 10 do pretty good, kind of a thing. So like 7 out of 10, you get nothing from, right? Even with those numbers, you would have significantly more at the end of 5 years than you would if you put that money into a 401k. All right. So anyway, so that was really interesting to hear Frank share that. A lot of the guy in my book, I think I call him John, my story, he had a corporate bonus. He was the CEO of a pretty big size company. It was the American subsidiary of a foreign owned company, and he took his bonuses because they were just extra money. He was already using his income for all the lifestyle stuff that he had, but he would just take that profit sharing or that bonus that he would get, and he would put that into angel investing. So that was the amount. And if it ended up being 40,000 in a year, then he would put that into 2 companies or 4 companies at 10,000 a piece. And so that was how he did it, right? So Shankar shared that he had invested in 100 companies in his lifetime. Now, he's been doing it for like 30 years. A long time, okay, maybe more. And he said the average return to an exit is 7 years, and he considered it very, very risky in general. He'd seen a lot of failed over that number of companies, but also had the big returns. But he said it's really, really critical to diversify within your allocation based on industry and stage. which I also talk about, right? Because we in any flux of the economy, there are, and any crisis that happens, right? You think about when 9/11 happened, what completely collapsed? Transportation, recreation, all that kind of stuff. All of that stuff collapsed. But we were on the beginning of fintech, right? So when we went into the .com, when we went into the real estate collapse of the Great Recession, fintech took off, right? And then you got a bunch of regulations that kind of, messed up some of the fintech, right? So between government regulations, a war, a pandemic, you can have all kinds of things that will come out of left field, black swan, and mess up an industry. So diversification is really critical on that. And also stage. One of the investors that bought my book, I got to know her. She is active in investing in Texas, and she reached out to me to get my opinion and advice about her diversification strategy. And what she was doing, which is a nice thing that we have now as a kind of a byproduct of crowdfunding. So she was doing her regular old, she was in an angel group, she was doing side investments with things that she saw, because her background is marketing and retail, and she was a mentor at a retail incubator. And and so she had those different stages, but she wanted to get some stuff that was a little bit later stage. And in fact, I remember another VC angel investor that I interviewed, he talked about the same thing. So he invests like micro ventures, for example, and some of these other ones will have those companies uh, that are close to going public. And you don't get as near much of a return as if you were on the ground stage, but you're going to get the bump of when they go from whatever that is, what they're selling at now, and then their strike price when they go. So it's going to be some bump that you're going to get. And the people that are selling those shares, because it's still private stock, are under these provisions, particularly under a Reg A plus. And if they've held them for a long time, and what some of these organizations, there's a shared equities, advanced equities, they do the same thing, but they do it on a personal basis with their own investors. But Microventures puts it up on their website. I get those emails, and it's companies that are about to go, and employees, the original employees, will sell some of their stock early to get the cash before it goes public, and then they ride. It's kind of like they sell some of it, so there's access to this. So now you can have later stage, on this. And so it like they talked about, startup, up and running, so they're past it. They've finished their A round. They're scaling. They're either going after venture money, or they're going after Reg A plus scale money, which is, where I work with entrepreneurs, is on the companies that are doing direct public offerings and need to get access to capital to bring them in, and a coach to run the program. And that's the services that we offer to the entrepreneurs. They are so that then, sometimes one of the gentlemen, I think it might have been Bird, talked about, some of them talked about, I'm not sure exactly who it was, might have been but they like to have a lead investor, because they know the lead investor, there's an angel group, for example, or something like that, they've already done the due diligence, and then they piggyback to finish the round off. That's some ways that some funds operate. A lot of the angel funds that pool angels monies and do that, that's the way they do. They finish out a round, so they know it's already been vetted. For those investors that are flying solo, we offer those due diligence services to help them make a decision of which ones, and then help them syndicate it with other investors if they have a deal that they really like. That's what we do for the investors that become part of the National Network of Angel Investors. So Bird's philosophy, his approach to it, which it really helps for people that are uncertain about this, because if you're investing in a company that's raising Reg A plus money, or Reg CF or intrastate, or even a 506C, odds are you're never going to meet that entrepreneur. I mean, you're not going to spend one-on-one time, because they're down the road. They got hundreds of entrepreneurs. You're not spending time with them unless you're like the super that knows this particular industry. But at the very early stage, at the seed stage, at the startup stage, being a person that has the flexibility to invest time and money and their Rolodex resources to to an entrepreneur is really great. And I have a program that we call the executive check for that, right? That we used to do all the time when angels came through my network of business angels and investors that at one point had been network of business uh, acquisitions and investors, acquirers and investors, right? Because they would go in and acquire a portion of the company and then shepherd them through the process. And a number of the investors that were my active investors at the time, they would go in and be an interim CFO. And the executive check would be one, I talk about this in the book, they would be where you might have 50,000 to invest, but you get $100,000 worth of equity because you're spending time with the company that might have been equivalent to a $50,000 salary. So you don't get paid because you're just putting your money in to get paid. That doesn't make any sense, but you can get more equity that's equivalent to what you're doing in the company, and it's you've got an obligation of what you accomplished for them, but then you get that equity once you've accomplished that stuff. When you work it and you work yourself out of a job, and now you just have the equity because you're going to eventually, when they have need a full-time CFO, for example, or a full-time CMO, or somebody that can set up their manufacturing, their operations, somebody can set up their distribution channels. If you've got real experience at that kind of stuff, that's another way to compound your access to these deals and be able to help them. But he likes to put in time and money to help guide the company. And the other thing that they said, invest in something what you're familiar with. It really is the Warren Buffett approach, right? And when you get the book and we go to the resource portal, I have a tool sheet where we talk about figuring out and scoring and creating a scoring system based on what you know. Now, maybe because of your career, it, maybe because of a hobby, you have it, or maybe a life experience, you just know stuff, about certain things, right? But, so like, for example, I was working with a company that had this really clever fish thing. And, the traditional angels don't have that, or tech angels don't usually do products. They don't usually, it's changing now because, there's so many ways to prove a product out under, reward-based crowdfunding. You can prove your market, prove your, get a product built and things like that, that was really almost impossible to do prior to 2012. And, he was like talking to me, and I said, here's how you do that. And this is, I've advised companies a lot of times, go to boat shows. The people at boat shows are likely fishers, and if they're looking at $100,000 boat, chances are they got money to invest, right? And you just start talking to them and develop a relationship and figure out what it is. You don't jump on them and like, hey, you want to invest? But there's so many, and I saw it with my own angel group. I knew people like invested in software, right? Or they invest in stuff like that. And the one time that we actually got a whole bunch of money together for a movie, it ended up that the way the pitch went and how they were going to go to market, this one investor had teenage sons that knew all about that stuff. And he knew that if that was, they understood their market, and he understood, that, and he and some other people put some money in, but they also negotiated some additional rewards within that process. And so there's so many ways to go about doing it, but I was so patting myself on the back, man, because everything they said, right, was what I have been saying and do say, and advise the investors that hire me to assist them, on how to get started and do all that stuff. So you're listening to it now. You have heard it again. And I hope if you're getting started in angel investing, or already in it, or been doing a few, think about what these guys have said about their diversification strategy and start to implement that. Because one of them, and I don't know who it was that said it, but out of 37 deals that they've invested in, they have had 5 exits with a 300% ROI, return on investment. That's amazing. That's a good chunk of change, right? And that's the reason why people do this. Once they get the bug, the greatest way to create wealth is to be the successful entrepreneur. The second greatest way to create wealth, and what has been the biggest secret of how the rich get richer for generations, like since 1925, maybe more, the start of our industrial revolution in the United States, was investing in successful entrepreneurs, right? Be the investor. And you don't have all the risk. You can always make more money, right? But you don't have to be that corporate executive that feels burned out and says, oh, I'm going to go quit my corporate gig and go start up a company. No, it ain't the same. It just is not the same. What you have to do, the fire in your belly that you have to be a successful entrepreneur. The recording I just did, that'll go live, or you probably have already listened to it with Vivek. That's exactly what it is. You got to have that fire in your belly, right? And execs don't do that. I know a lot of VCs and angel investors that will not invest with companies that are founded by former execs of Fortune 5,000. Doesn't even matter. If they spent 20 years and all they've had was secretaries and people doing stuff for them, they don't have what it takes to be a startup. They can maybe acquire another company, but it's still a whole nother game. But what they have is the ability to get passion from the companies that they're investing in, because they have extra cash as this profitable executive, and they've got time. And so they can put time, money, knowledge, resources, capital into entrepreneur endeavors to bring innovation to the market, create jobs that grow our economy, and create wealth for all those involved, the founders themselves and those employees, as a compassionate capitalist. Yay, I said it. So making money, investing in the passions of the company that you like, that you think has what it takes to succeed. And with that, I'm going to say thank you very much for tuning in. Onwards and upwards. Please share this podcast. Please rate it. Please go to iTunes or wherever that you might see that there's a review, and give me a review, a good one. Only a good one. And thank you so much.